9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We are counting down to the reopen of mainland markets after the Lunar New Year holiday. Let's get to your top stories today. Stocks across the Asia Pacific are under somewhat of modest pressure. This is really on fresh anxiety, particularly in the U.S., over AI's impact on companies combined with tariff uncertainty.
Yep, a bearish report on potential AI scenarios hitting shares of delivery, payments, and software companies. We speak to its co-author, Lotus CIO, Alap Shah.
Now, onshore Chinese stocks may buck the trends at the reopen today, though, on optimism about lower U.S. tariffs and also homegrown technologies.
And the U.S. said to be preparing national security investigations that would enable President Trump to impose new levies after last week's Supreme Court ruling.
Good morning. Welcome to the China Show. We're starting things off today with some breaking news. No change in the loan prime rates for Feb. That's both in the 1 and also the 5-year, which also means we're back to business. Business is open again on mainland China, which also means markets are reopening today, everything from equity markets to bond markets and commodities. But yes, first one out of the gates, unchanged there. We're looking at a little bit of weakness now coming through in the Chinese currency. That should be coming up on your screens. We're now at 689 there against the U.S. dollar. We're coming from about 688, so we were flirting with the stronger end of things. But yes, lots to talk about. There we go.
It looks like it could be a catch-up story for Asia markets, right? You take a look at what we saw in Hong Kong, certainly. The positive backdrop that we saw regarding tariffs, right? It's a Supreme Court decision to deem these IEEPA tariffs essentially illegal, does benefit China in some ways. Morgan Stanley saying those effective tariff rates have now been lowered to basically 24% for China. So we saw that rebound sparked by a lot of that optimism around the trade situation. And then you add the sort of AI pure plays that we've been seeing in China that have really been largely insulated from this whole scare trade over on Wall Street. And, you know, this Citrini report that we got certainly was one of the first sort of triggers over the weekend that sent things into a bit of a tailspin here. And
it's coming on the back end of successive days on Wall Street of sector after sector after sector that this AI scare trade. And then you have
this almost piece of fiction.
Almost like a very good fiction story at the end that really extrapolates not too long from now, right? About 2 years from now, that really tells a story of how this might actually play out as far as the real economy is concerned. So we'll dig into that. Obviously, there's certainly a massive market angle to that. To mention, of course, when you look at the AI trade in China, which is almost operating as a separate system. So the correlations there are not as close as you get in the U.S. But yes, obviously going to the reopen today is going to be something.
And it wasn't just the Citrini report, right? That came out on Sunday. Then on Monday, you had that warning from Anthropic saying, you know, some of this new Claude, was able to, you know, replace some of the sort of coding that was in IBM computers, right? So that sent IBM stock
so old school, though.
Lower. But the worst plunge we've seen in 25 years for that company as well. And then you add what we heard from the author of The Black Swan, Nassim Taleb, just to add more fuel to the fire, warning investors to brace for more volatility as the AI rally enters a more fragile phase.
Historically, if you look at history, the car companies, airline companies, and of course the personal computer, okay, if you look historically, that those who started the business, the pioneers, are not necessarily the winners. As a matter of fact, they're probably more likely to be the losers. So now people take names of AI and say, okay, these are going to win, let's invest. I'm sure someone's going to make a lot of money in both software and hardware related to AI, but doesn't necessarily have to be these companies, because you have a lot of instability, both technologically and, of course, in geographically with AI.
You know, markets in Asia Pacific, as we perhaps just alluded to a few seconds ago, are taking this one in stride. In stride relatively, of course, to the deep sell-off that we had across some big names in the U.S., right? So Asia Pacific on your screens, you have, of course, a couple of markets coming back online today. You have Japan coming off, of course, a holiday. Mainland China coming off a very long one. So we're calling it flat right now on the regional benchmark. Japan is doing some bit of a lift. I imagine Taiwan coming online, and it's up again, 5 straight days there. And SoftBank, of course, is the separate related story to the AI play, is also pulling, at least removing some of the points gains in the Nikkei, at least for today. Kospi is about flat, finally. No gains there. Dollar is actually stronger from 24 hours ago. Dollar Japan is coming up on your screens. We showed you dollar China back to 689. So interesting what the fix is going to be, the first one in a while. And of course, that spread between offshore and onshore. It's also worth pointing out that the Stock Connect resumes today, so you're going to get that volume coming through here into Hong Kong across the south, assuming of course we get some buying. Gold and Brent on your screens. Not much change there. A50 futures coming up, both contracts, the 10-year Chinese government bond yield. You have bond auctions today, just keep that in mind. And of course, dollar China, there we go, at 689 against the US dollar. We are poised to open slightly to the downside because of some of the tailwinds coming through overnight.
Yep, and really the report that may have been the catalyst of what we saw overnight really started with a really key question, right? What if all this is too good to be true? That maybe it turns bearish, right? What if our AI bullishness continues to be right? And what if it's actually bearish? Here to tell us a bit more, joining us now from New York, is the person who posed that question, Alap Shah, CIO of Lotus, who co-authored this report with Citrini. Alap, thank you so much for joining us. It's interesting. It seems like you had a lot of fun with this whole sort of report that really played out something that the timeline of which is 2028. So we're talking only about 2 years' time, the disruptions that we could be seeing from AI. Tell us a bit more about that timeline here, and what's the probability that this could actually come into fruition?
The timeline, we were seeking to just find a time period that is far enough away that ultimately we can start driving a conversation on what needs to be done to avoid such a timeline, but near enough that would kind of shake people a little bit, and ultimately we do think it's going to take a while for this to diffuse through the entire economy, but it's more a question of what happens at the leading edge. I think especially in the U.S., the job market is just very weak for white collar jobs already. And so the thinking and the ultimate fear is that it's not going to take that much to sort of push things over when we haven't really generated any white collar jobs in the U.S. over the last 3 years. When they take out things like healthcare and education that are primarily driven by government spending. And so that's kind of the underlying thesis here, is that there's going to be significant replacement of jobs with AI, specifically AI agents. Those things only really came into fruition in the last few months. And so as it comes through and shows up in the productivity of different corporations, that's when things are going to get a little more interesting and where we got to pay real attention.
Alap, David here, were you surprised by the market reaction?
Yeah, I was. I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically, the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months, and it's going to start changing. It's not just going to accrue to the benefit of every corporation and every foundation lab and every semiconductor company, but instead it's starting to disperse and figure out, hey, who are the winners going to be and who are the losers going to be. And so, software is the best example. The markets have been selling software for almost a year now on the AI threat. But they really accelerated in the last few weeks. And this is, the problem with this, if you're long software, is there's nothing to actually disprove the thesis, because the thesis is a few years out. It's not today, but you have not much to stand on, because ultimately that thesis is going to get stronger as AI itself gets stronger. And so we just are entering a really kind of highly volatile time in the markets, because the timelines are short, but things are in fact happening now.
Yeah, I was about to say 2028 is closer than the most recent presidential elections, right? Let alone the pandemic, which in my mind seems still very, very fresh. Alap, I just would have been doing my duty if I didn't ask you this. Were you or anyone at the research firm short these names going into this? Was this a short seller report guised beautifully in the form of a beautiful fiction?
We are constantly sort of, turning our book, and we certainly had shorts in some of these businesses. We generally have a set of shorts out against businesses that we think are going to be disrupted by AI. And on the other side of that, we own a lot of semiconductors that we think are going to benefit. But ultimately, we just wanted to get this story out to the market because while the risk to individual stocks is certainly meaningful, the main story for us is that the risk to the overall economy and ultimately the consumer economy in a world where we don't figure out what to do if the jobs start going faster than we think.
And you highlight quite articulately just kind of what sectors might be hit, right? I think food delivery was certainly the one when you mentioned about DoorDash, Uber Eats and the like. This is really kind of the fee-based business model. You mentioned, of course, software was sort of the opening shot. What other sectors do you think could be the next victims here? I know you lay out a whole list of them, but what are the ones that we really need to focus on? And maybe what are some of the sectors that are best positioned in this whole AI scare trade?
Other sectors that I think we think have real risk are just generally intermediation sectors. And so DoorDash is an intermediary. It runs a marketplace for food, Uber for cars. But I think where the markets are just beginning to sniff things out is most of financial services is ultimately intermediation. Insurance companies are intermediating risk. Banks ultimately, when it comes to their credit card businesses, as well as their lending and sort of deposit businesses, are an intermediary as well. And so the real basis of this thought exercise was just thinking, hey, imagine it's 2 years from today, and most of the things that you do on your phone, instead now your agent does for you. So instead of having to open up the Chase app and go into Zelle and send a payment, you just simply speak to your phone, hey, send a payment to my friend. In that world, you are a lot less tied to the UI of the Chase app and your bank branch and everything else, instead of just, hey, whatever gets it done most easily and ultimately most cheaply. And so right now, the high-level thesis of all these intermediation businesses for us is that they are generating great returns because the customer wants one relationship, maybe two relationships. They're comfortable with that brand. They're comfortable with the UI. They're comfortable with their locations. And so they just stay with them. But in a world where you have an agent and the agent's job is to just look for better prices for things all day, every day, it's going to do a good job of finding you alternatives where you don't really feel the friction of moving from Chase to Citi because it's doing all the work for you. And similarly, like if you think about in financial advisors, right now it's really hard to move your money from one financial advisor to even an ETF, right? You've got to open these accounts, you've got to make all these transfers, you got to do all this research. If the AI comes to you and just says, "Hey, you're spending 1.25% a year with an advisor at Raymond James, and instead, you can get essentially the same return minus those fees with this ETF." It will be, for some folks, it might be a lot more compelling to make those changes. And so a big part of the way these businesses have moats and sort of keep their customers every year is that there's just a lot of friction to changing. And that friction really drops precipitously in a world with agentic AI.
Yeah, what stood out to me too is, agentic AI, as you point out, the technology does not consume the same way humans do, right? Discretionary spending, food, travel, whatever. So that massive, capital flows that would usually go into, things that we consume, goes, if you think about it, goes straight into the pockets of the big tech. So I want to differentiate, I guess, the concepts from this being bearish on humanity and bearish perhaps on labor markets, because you do have some big winners that seem to be emerging under your scenarios. And how do you look at the big winners? It might necessarily not be too bad for markets, is what I'm getting at here, Alap.
It's tricky as far as how this goes for markets if this plays out. Clearly, semiconductors are huge winners. Things that are upstream to semiconductors are huge winners. So everything required to construct a data center and ultimately kind of material stocks are huge winners. Clearly, foundation labs are huge winners. And then businesses that have sort of true economic moats are also big winners. So things like, ultimately, things like brands and other status goods that, as long as the consumer continues to spend, will do well. But the flip side is, the real thing to sort of underscore is, if this plays out, and especially if it continues to play out without a policy response, then the thought experiment we use in the first piece is, let's say 5% of white collar workers lose their jobs in 18 months. And there aren't other white collar jobs for them to get because the white collar, just economy is shrinking pretty badly. What are those folks going to do short of any policy response? They're going to have to go into the blue collar markets and the gig markets to try and make ends meet. That is going to massively depress the average price that someone's going to be able to get for working in the blue collar markets or the gig markets. And so it's all one closed system. It starts with white collar, but it is one closed system. And so if we let AI replace the jobs without taxing the AI appropriately, then it can really get to the core of the consumer economy. And that's where some of the real contagion cases can happen. Now, as long as we are clear-eyed about what's happening and then take steps to make sure that, we're not trying to suggest that we should just massively increase the tax on AI companies or semiconductors or anything else, but there are going to be a clear set of winners and a clear set of losers from this scenario playing out or other scenarios that rhyme with it, which seem very likely in an AI world. And our point here is that, we should be looking hard at figuring out how to tax some of those incremental gains, windfall gains really, and sort of keep our society running and whole. And if we're able to do that, and then, let's say that 5% job loss happens in 18 months, but it only translates to a 1% or 1.5% decrease in consumer spending, then we can kind of work our way through that. But if it translates to a 4 or 5 or 6% decrease in consumer spending, then it's very, very scary.
You mentioned about the need for policy. I just want to kind of mention a little bit more about this negative feedback loop that you're saying that this could have on the economy, right? You're saying AI getting bigger, better, and cheaper. Companies lay off workers. They use the savings to invest more in AI capabilities, lead to more layoffs, displace workers, and then companies that sell things to consumers sold fewer than weakened. And then you have used AI to protect margins. AI got better and cheaper. A feedback loop with no natural break. You mentioned in this report, though, there's still time to direct toward a different future, that we're not quite there. And we can't avoid that sort of extreme scenario right now. I'm just wondering what is going to be what breaks this negative feedback loop?
So the underlying feedback loop is that the smarter the AI gets, the more things it can do, the more jobs it can replace. And that we think of as very secular. It's never going to end. We're just going to continue to be able to improve it. And so the feedback loop needs to be broken from a policy perspective. And so that means that we need to understand kind of where the jobs are going, what's causing the displacement, and then figure out how to tax the incremental gains or the windfall gains from AI. And those will accrue in two places. They'll accrue in the AI complex, so to material stocks, semiconductor stocks, and foundation lab company stocks and some tech stocks. But the other place likely that it will accrue in an even larger form is in companies that are able to cut a lot of jobs but don't have their demand suffer as much, because their margins will also explode. And so, in that world, it seems a little asymmetric to have the same corporate tax rate for someone who is selling food as somebody who's selling a semiconductor. When that incremental semiconductor is costing 10 jobs and can really, hit the market and the economy. And so I think we need to start thinking a little bit more expansively about how we structure our tax code so that, we can maintain the equilibrium. And ultimately, in that world, we think it's very bullish because, AI is massively increasing productivity, GDP growth can zoom. And we think be in a world where, there's a lot of more abundance than there is today in a relatively short order. But if we want to maintain the system as it stands now, rather than tear it up and build a new one, or tear it down and build a new one, then we got to think about sort of tax policy that is targeted specifically at what is driving those job losses.
Are there specific milestones? Okay, let's just say it's a very useful fiction at its worst. Let's call it that. 2028, you mentioned at the top that that's just something that you guys came up with that is not too far but not too near enough. Are there specific milestones, let's call it over the next 5 years, even that seems long, but over the next 5 years, specific milestones that you think we should be watching to figure out and course correct or, figure out whether or not we are headed down this specific path?
I think the biggest tell is white-collar employment in the U.S. economy. We think it's going to happen the fastest in the U.S. because AI is largely being built there, and it has the most dynamic labor markets, and so it's much easier to fire folks than it is in other parts of the world. And so I think the white collar labor market and then maybe the sort of eye of the storm is really information workers and their hiring. Based on the work we did, that employment by information category workers is already down almost 8% from a peak in 2023. And so that is particularly scary. Some of that was like COVID excess when they overhired after coming out of the pandemic, but that's down a lot. And that maps to places like big tech where you see, round after layoff as they're getting more efficient and as they're able to roll out AI to do more things. And so I think the ultimate tell will be the employment that sort of the makers of AI and the sort of most advanced users of AI are putting out. And then I think other folks in that complex. I think the further you go from technology, the slower the diffusion is going to be. But we can clearly see it in technology. It's a pretty scary picture. Yeah. And there's a reason why it's not going to spread elsewhere when we're seeing the capabilities advance so fast.
Alap, it seems like this really is more of a market story rather than maybe a tech story in some ways. I'm just wondering, what we're seeing the market reaction, we're not quite seeing that here in Asia, particularly when it comes to China itself. In fact, some of these pure plays in China are actually outperforming, and it has been a dominant theme here in China. Is there a sense, China's making cheaper AI models. Is there a sense that they can actually in some ways overthrow some of these offerings, the likes of Anthropic and what they're doing now, at least outside the US?
I think there's two really interesting observations with what's going on in China right now. I think clearly these foundation lab companies that have recently listed are really zooming. It's not surprising to me. They're really the only way in the whole world that you can get exposure to foundational lab companies because none of them are public in the US except unless you want to buy Google when you're buying a bunch of other things too. And so clearly there isn't that much supply. Everyone in Asia, but I think, folks all over the world are rushing to buy these stocks in Hong Kong. And so it's not surprising to me that they are outperforming and other parts of the AI complex are outperforming. The other thing that I find really interesting about China, and maybe that reflects in kind of what you're seeing in a very muted response today, is there might be a good analog here for what happens over the next 2 years in the US to some extent what has happened over the last few years in China, where as technology, not some AI, but other things as well, especially automation, have really rolled through the economy in a big way. Jobs aren't being produced at the same level. The average corporate can do a lot more with less humans, and they're able to ultimately not hire, and it leads to sort of a pretty weak consumer economy that kind of can drag the entire economy down. So I think there is probably some interesting analog there as well. And so I think, there's just a lot less expectation sort of embedded in sort of China's growth from a consumer perspective right now. And so thus, this, if it gets a little bit worse, shouldn't matter in the same way that, there's quite a bit embedded in kind of the US.
Alap, thank you so much for the time. It was great to have you. Alap Shah there from Lotus CIO, who co-authored this report from with Citrini Research there. But yes, look forward to your next piece as well. Of course, we've got to look ahead to another theme, which is the reopening of mainland markets here today. Take a look at how the pre-market is set up here right now. We're just about 7 minutes away. We are seeing maybe a possible catch-up after that 9-day holiday. So certainly that's one thing to watch here. And of course, key to watch is not just the stock side of things. The currency, the renminbi, has been also stronger here, given some of the tariff headlines that we've seen. And David, you've been watching a lot on how these oil markets and, of course, the precious metals trade and the like, and how that's going.
Yeah, because, when we went into the long holiday, and we've talked a lot about how this is really a very long one as far as mainland China was concerned, right? 9 days. That's really when the Iran story gained a lot of momentum, right? Yeah. So you had Brent prices north of 70, 71, 72 at one point. And it's unsurprising why you look at Shanghai crude, as you see on your screens, right? We're up 5% in that catch-up trade. The rest of the markets, including, I would say, FX, including between offshore and onshore, are actually not as untethered as you were with energy markets. But yes, this is certainly one thing we'll watch going into the open today, including its derivatives in the equity market. Okay, let's get more on this mainland market reopened today and really what we should be making of this underperformance, largely on the index side of things. David Wong joins us, Senior Investment Strategist, Global Co-Head of Equity Business Development at AllianceBernstein. David, good morning. And first off, thank you so much for being patient with us. And I wonder if you caught some part of the latest interview we just did. But okay, just talk to us then. The starting point, equity markets, when you look at EM, as China's been left behind this year to date, Hang Seng Tech Index, Chinese tech stocks, platforms have underperformed. How are you looking at this price dynamic right now?
Sure. Thanks very much for having me, David and Yvonne. I would characterize our current view on tech in China as being somewhat neutral. We do like other opportunities elsewhere in the region a bit more, but from a China perspective, while AI, as your last guest, patently made clear, is very much the main concern of markets and also the source of greatest opportunity. We think that a number of the AI-themed companies in China are a little bit extended at this particular juncture. And to the extent that we are engaging in the AI infrastructure trade, we want to do so from a second or third derivative perspective where valuations are not quite as challenging. We do like some parts of the consumer market. We took some pleasure and comfort from what we saw in terms of retail activity in China over the long holiday. And in terms of what we continue to bang the table on at this particular juncture, it really is in the materials sector, which we think is a great opportunity in China, not only because of AI, but also because of anti-involution policies and improving supply-demand dynamics in the metals and commodity sector.
Yeah, you said that in terms of the A-share market, you're still overweight some of these idiosyncratic sort of themes, right? And maybe the less crowded AI supply chain plays. I'm just wondering what that might be. For now, it seems like investors' preference is really the pure AI plays over the internet giants. Is that how you play it?
Yeah, that's actually why I mentioned the materials sector. People don't think of copper and copper mining as something that is AI related, but it is very much part of the power build out that will be necessary to fuel all of those data centers and the infrastructure in general that China and, frankly, the rest of the world requires. It's also a key element, along with other materials, for battery technology, and battery storage will be part of what will be necessary for us to use, things like wind and solar, for instance, and to really capture all of the different sources of power that we will need to harness to power all of these data centers. And when we look at how the supply and demand dynamics are working, we think because many of the mining companies in China are state-owned enterprises, they do tend to pay more attention to government policy. So we're actually quite excited about this part of the market today.
Yeah, that's also a good point that you make, right? This is also an anti-involution beneficiary if you look at those two sort of that Venn diagram where these materials come into play. You talk also about, since we're coming out of the holiday, talk to us about this call around some of the travel-related stocks, whether that's hotel, hospitality, F&B. Is that a place in the market I should be entertaining at this point?
We absolutely think so. Well, when we look at RevPAR numbers for some of the lodging companies, they have been sequentially improving every single quarter. And what we also see is that while Chinese travel abroad has been muted compared to past years, we are starting to see a gradual recovery. We are seeing more interest in independent travel, and when all of this dovetails with visa-free access for Chinese citizens, we do think that this is actually a real positive. And there is seeming to be an improvement in inbound tourism as well. So there's a lot of things to like in the travel and tourism sector. And while certainly the recovery of the consumer is uneven in China, this is one of those areas namely experiences, where the Chinese consumer still seems willing to spend.
David, thanks so much for joining us here as well. David Wong, Senior Investment Strategist and Global Co-Head of Equity Business Development at AllianceBernstein. Your market open just happening here right now, and here you go. You are seeing at the early side of opening trade here after 9 days of holiday. CSI 300 coming back with a catch-up trade. We're up about 1.5% for the CSI 300. Shanghai Comp as well as Shenzhen is seeing gains of more than 1%. We talked about that catch-up when it comes to not just stocks, but also when it comes to crude markets, given the volatility that we've seen around oil prices. There you go. You're seeing a 4.6% when it comes to Shanghai crude. Copper is also catching a bit here today. Iron ore, though, seems to be heading the opposite direction. We're down some 2%. But then it is still some of the AI plays, chip plays, seem to be still doing quite well. Even the consumption plays like Medea Group are all seeing gains of more than 1%. Capricorn Tech also up more than 1%. So right now it seems like things are doing quite well. Commodities, bonds seem to be not doing too much, but we'll see how the onshore rate trades here. Of course, that takes a little bit of time here, but we have seen, of course, given the tariff situation, the dollar has seen a broad decline. So renminbi has been trading on the stronger side of things. Let's take a look at how Hong Kong is faring here, because we did see that quite a rebound yesterday here. How we open right now, there you go. It seems like we are coming off what we saw yesterday. So we're down in terms of HS Tech by about 1.5% here today. So maybe they are feeling some of the fears of the AI scare trade here today. But you're seeing the likes of Baidu, that's down some 2% here as well. Alibaba, Tencent also seeing some downside moves. HSBC, even the darling, ahead of those earnings, are also down here today. A property, that certainly is one thing. I think Sun Hung Kai had some pretty interesting numbers that came out here, or at least when it comes to the preview.
Yeah.
They're expecting some pretty, there might be some pretty good numbers in terms of the recovery that we're seeing in Hong Kong as well. So, right now we're seeing that. We're talking about some of the AI peer plays, right? So yesterday we saw a massive drawdown on some of the 8-share ones, Minimax, Zhipu, by double digits. But this is after what we've seen. I mean, right, these stocks have gained fourfold since they listed, right? Mixed picture here right now, but more threads onshore is seeing a little bit of gains here today. Dave.
Yeah, we're looking at Minimax specifically, and I really like that word distilled, because there's really this element of almost an engineering aspect that you are trying to just separate two elements here. Alcohol is a very good example, right? How you distill something off a specific liquid and then just split chemically what goes into that. And the reason I bring that up is distilled was a very strong word that was used here in terms of Anthropic, DeepSeek, and Minimax distill these AI models here for gains. Belle is with us here to talk us through this, our Asia Tech correspondent, to tell us what we know about all of these things here.
I'm going to take it from alcohol back to the technical side.
Okay, please, go ahead. Yes, no, that's a reference I'm familiar with.
We're talking about distillation techniques, and it is familiar because it was a similar sort of allegation that OpenAI levied against DeepSeek just a few weeks back. But in an AI sense, distillation refers to essentially a compression technique. So what you're doing is putting a small, compact student model in a position essentially to train off one that's larger, that's sort of like that teacher model. And so you want it to essentially mimic the behavior, the performance, the knowledge. And that is the allegation that is now also being levied at not just Zhipu, but also, or rather Minimax, but also we've got a couple of others that are in focus, DeepSeek, of course, and then Moonshot. Moonshot continues to be held privately in China, and DeepSeek, of course, we're very familiar with that name. But saying that in aggregate, these three models have been doing exactly that. They've been generating more than 16 million exchanges in total with the Claude models, using thousands of fraudulent accounts. So going back to that sort of covert network, how they're getting past those sorts of security parameters that are in place. But yes, as I said, OpenAI said a similar thing about DeepSeek earlier this month in a warning to lawmakers, and it is something that's in the eyes of lawmakers as well in Washington, because the AI czar, for instance, David Sachs, has also expressed very much the same concerns here that DeepSeek has been using these distillation techniques. So yeah, I mean, the whole idea was DeepSeek was using more with less. I guess it's also that question of the methodology they're using to do that as well.
There was also, what we saw in the IBM's situation, right? That this Claude was able to basically improve some of the language models that were in these IBM machines. So can you explain a little bit more about that warning from Anthropic?
Yeah, so this is talking about COBOL, which is a computer programming language that actually was first introduced in 1959. So that just tells you how old it is, 1959. And what IBM is saying, or what Anthropic is saying, is that its Claude code tool essentially can improve or modernize this computer programming language. And I think it's very interesting the way that they're sort of pitching this as well. They're saying that given the age on this, the people that obviously created COBOL have long since retired. There's just a handful of universities as well that are teaching COBOL today. So there's basically no one that's coming into the market to be able to do this. And so they put out this statement saying that essentially, they can do what would have otherwise taken people years of mapping to do, they can do just in a very short space of time with this Claude code tool. And that is why you saw such a sharp sell-off in IBM, because it still makes a pretty big chunk of its revenue from mainframes, and many of these rely on the Claude programming, the COBOL programming language, and COBOL is used extensively across a number of different sectors, including finance, airlines, government. I mean, it's really integral to the overall global economy.
Yeah, hence that reaction that we saw in the stock. All right, Val, thank you. Annabelle Julius there, our Bloomberg Tech correspondent, on the latest on all things Anthropic, Minimax, as well as IBM. Let's continue that story, right? Because it was also this interview with the Black Swan author, Nassim Taleb, with that warning that really spooked investors as well, saying that, brace for escalating volatility and potential bankruptcies in the software sector as the AI-driven rally enters a more fragile phase. He also told us exclusively that tariffs can be effective if implemented predictably, but erratic execution discourages investment.
The tariff policy, tariffs can be a smart thing. The execution of that is completely crazy and erratic. It doesn't give you an incentive to invest. So if you know that they're going to have tariffs permanently, you go invest in the sector. We don't even have that. They can change their mind. Again, an erratic administration is not helping. And plus, the tariffs are not selected in a way to be rational, because they affect a class of the population that's, it is a regressive tax, so it's going to have an effect. If it doesn't have an effect yet, eventually things will show.
On low-income consumers specifically, or just bigger economic picture?
Overall, you have a shift. You have a shift, for more inequality, and this exacerbates it, and it's not helpful in the long run. And that shift for inequality has been exacerbated by AI.
Let's talk about AI, by the way. So we saw a huge sell-off in the stock market, driven specifically by some AI names. What is your take? What's happening?
Again, it's structural. That historically, if you look at history, the car companies, airline companies, and of course the personal computer. Okay, if you look historically, that those who started the business, the pioneers, are not necessarily the winners. As a matter of fact, they're probably more likely to be the losers. So now people take names of AI and say, okay, these are going to win, let's invest. I'm sure someone's going to make a lot of money in both software and hardware related to AI, but doesn't necessarily have to be these companies, because you have a lot of instability, both technologically and, of course, in geographically with AI.
So does it mean you expect bankruptcies in, let's say, software space?
Definitely. Plus, the effect on the stock market, as you realize, that the previous rally that we had was driven by a very small number of names. And now we probably have some rebroadening effects on redistribution. But a lot of the gains in the stock market, are going to be eradicated by that. So this is why you have, we're at a juncture of a lot of instabilities across many domains.
That was the author of The Black Swan, Nassim Taleb. They're speaking exclusively with our colleague Natalia Niazevich in Miami. Right, a reminder for everyone, of course, who has an internet connection, our new online feature, and of course for our Bloomberg clients and subscribers, you can check out this new hub we have, live streaming news, interviews, and all Bloomberg TV shows, documentaries, reporter analysis, and more. Our new video hub, of course, is online. Check it out, bloomberg.com/videos. We'll leave you with a look at markets. We're going into 10 minutes into the year of the horse for mainland markets, coming back online today. Galloping out of the gates.
Dashing. Not really, but yeah, dashing.
Through the snow if you're in the U.S. 1% to the upside, CSI 300. This is The China Show. Right, welcome back. You're watching The China Show. An EU assessment has found that President Trump's new tariff policy will raise levies on some of the bloc's exports above levels permitted under their trade agreement. Now, the new global tariff will be added to existing levies, resulting in goods like cheese, butter, plastics, textiles, and chemicals facing duties above 15%.
All right. We have some latest lines here when it comes to what the trade discussions are looking like here. When it comes to the Chief Cabinet Secretary of Japan. So this is Minoru Kihara speaking this morning. So they say they plan to proceed with the U.S. trade agreement, and they also talked about when it comes to Canada's PM, Mark Carney, is going to visit Japan next week as well. So certainly that's one thing to watch, but they are assessing right now the impact of this U.S. tariff ruling. So it seems like right now they are going to keep how things hold when it comes to some of the trade negotiations between the U.S. and Japan. But certainly we've been talking about what this means, right? Whether it's 10%, whether it's 15%. Have we reached sort of a peak when it comes to U.S. effective tariff rates, right? I think Morgan Stanley sort of made that line here. And Bloomberg Economics has also been sort of crunching the numbers a bit about, it seems like in some ways U.S. allies, maybe like Japan that had negotiated pretty good deals with the U.S., they seem to be maybe less competitive now compared to some of the foes, right? When you take a look at, the likes of India, the likes of Brazil, the likes of China, for example, that are now, are exempt from these sort of IEEPA tariffs. And they mentioned, right, when China, we're talking about what prior was 31%, we're now talking about 24% where those effective tariff rates could land. Yeah. If in fact it holds true, the 15% rate.
Comparatively to where the rivals, the prior tax rates of the rivals itself, right? Not absolute levels. But interesting too is, this time last year, we were as confused as to what the tariff regime was going to be going in. And at that point, right, we were a few weeks going into Liberation Day and week, right, which was first week of April. And certainly what's interesting is that we're here 12 months on. We're still trying to figure out where the tariff guardrails are going to be. Yeah. And I think that really puts the point we just did about the EU, this line that's coming through out of Japan, where you have U.S. allies now figuring out do they stay or do they wait? This new tariff regime. Right. Let's get more on the numbers that we just showed you there. Bloomberg Economics thinks that we were just talking about this. While China does stand to benefit from some of the top court's decision on tariffs, the boost to exports and growth might actually prove fleeting and really make almost not a material difference as far as the growth picture is concerned. Chang Shu is with us, our chief Asia economist, is here on set with us to help us break down the numbers and the eventual impact this is going to have on growth, which is more consequential.
Yeah. So certainly this positive news to some extent. You already highlighted the figures now. With a global flat rate of 15%, China could see an average or effective tariff at 24%. That's still above the world average now that with 15%, the world average tariff rate will be 12%. China is still not competitive compared to the world. Yes, yet it's less so compared to before. So that's positive news to some extent, but there's so much uncertainties and the situation is so fluid. So we don't know exactly what the tariff regime is going to be. And for China's particular circumstances, Chinese exporters over the past few years have been reorientating away from the U.S. Given the uncertainties, given the fleeting nature of the current regime, it's not clear how Chinese exporters can quickly reorientate their supply chains to capture the benefits from the rate cuts. And separately, very quickly, China has been very resilient in its exports, and the resilience doesn't come from the tax rate, a small tax rate changes or something. It's more coming from its strength in its exports. It's been diversifying. It's rolling out new products to export to the world. You think about EVs and batteries and so on. So benefits can be small and too quick to capture, really.
Yeah, you mentioned this export challenges have already taken a new shape, a new fight, right? It's more about, it's so strong that it's straining ties with allies. Maybe it's not just about U.S. Anymore. You also mentioned that this could also prolong some of the deep domestic weakness that we're seeing in the economy. Can you flesh that out a little bit more?
Yes, indeed. We see a challenge of different sorts. We talked about the strength, but the strength also means that China is running the biggest ever external imbalance the world has seen. We saw that last year China's trade surplus against the world was 1.2 trillion, and that's causing concerns across different parts of the world. There are strains with the EU, and I recently visited Vietnam and Indonesia. You think those countries are on the same supply chains as China, yet they are still concerns. I mean, they certainly welcome China's exports to some extent and China's investment in their countries, but at the same time they're concerned about the large exports. So China certainly needs to work with its trading partners to ease those tensions. In the meantime, China really have to sort of work more aggressively to promote domestic consumption and absorb those products more domestically.
You know, this came up actually interesting. You bring up that the reason exports in China are doing so well is not because of the tariff rates. It's because you have an ecosystem that allows for exports to be powerful. And this was brought up yesterday. Remember when the AmCham Hong Kong came up and said an emerging trend has really been foreign American companies returning to China because of the stable supply chain and policy framework that you have there. So my question to you is...
may I add?
Go ahead,
Yeah, may I add to that? There's also the scale issue, So,
yes.
I mean, the scale cuts down costs as well.
Okay, and you can't replicate that anywhere else.
Yeah.
So you put that together with the fact that it's a stable policy regime.
Yeah.
Do you expect this export machine to keep exporting this year? How big do you think this current account's going to get this year?
It's hard to make a projection on the 4 year the surplus, but I do anticipate the export machine will keep strong going for months and potentially years ahead. I mean, China, as I understand, is making efforts to work other countries, and it has shown some progress. For example, China reached a trade deal with Canada, and there appear to be progress in discussions with the EU. And surprisingly, we're going to issue a note shortly this afternoon when I visited Indonesia. There was a surprising warmth towards China in Indonesia. And because for Indonesia, they have a downstream agenda themselves. They want to move from simply exporting raw material to do more processing by themselves, and China is investing in that. But at the same time, some other countries, for example, EU, this is what the locals told me. The EU, for example, would label the restriction to export raw material as non-tariff barriers. So sort of tensions with some of the countries, with other countries. So at this point, there's a need certainly for China to do more with trading partners.
Fantastic. We look forward to the piece and the note coming through as well. That's really great context there from Changshu there, out of our Bloomberg Economics there. More reaction now to tariff developments. You have the Bank of Montreal CEO, Darryl White, says he's not surprised by the muted reaction that followed the Supreme Court decision to strike down President Trump's tariffs.
Yeah, he tells Bloomberg that many other corporate clients have adjusted to the swings in trade policy under the Trump administration.
I think it's early days. I mean, the announcement's a couple of days old on IEEPA. If you look at the market reaction, it's been pretty subdued, as we've all been talking about this morning. I think part of that is because some of the outcome that we saw over the last few days was probably priced into bond markets, so we haven't seen much of a reaction there. And if you talk to most of the corporates that we're dealing with, the reality is over the course of the last year or so, the instability and the volatility that's been brought by various decisions over the course of the last year on tariffs have become a little bit more normal course. So in the meantime, they've rebuilt supply chains or organized themselves in different ways to have resiliency in how they think about dealing to surprise, or maybe not such a surprise, as the case may be, depending on the audience. So in the meantime, more stable than you might think.
How much do you hear also a discussion around domestic production and expediting some of the licensing around getting, say, for example, the copper mine in Arizona up and running at a time when there is this priority on metals of all sorts?
Yeah, that's a live conversation. I mean, I think it's a very important one, because if you think about the confluence of two forces, we've got the demand being driven by the AI power up. So the newest industries are literally dependent on the oldest industries. In addition to the global order reorganizing at the same time, there's a massive demand push here. And the response to that at the end of the day is going to hit a bottleneck on the supply side. So the needed reorganization of permitting, of getting to market faster, of regulatory reform is a really active conversation. And I think, as you know, we're seeing some positive developments on that, particularly here in the United States.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session after 9 days of holidays. And really, we've come back on a pretty strong footing here, that catch-up trade, although we've come off some of the initial highs. But largely speaking, if you look at how the region is doing, it looks like we've kind of avoided most of the AI angst of this whole scare trade that happened in the U.S. We're focusing on, of course, the return of China here today, Dave.
Yes, and we are galloping quite nicely with an open stride and perhaps a more visible outlook as far as the path ahead is concerned here. So CSI 300 is up 9/10 of 1%. In fact, later on we'll show you what's happening across the stock connect. Of course, we resume to Dre across that connect between mainland exchanges here in Hong Kong. Benchmarks are looking like this. In fact, it's the opposite. It's the opposite direction as far as price is concerned. It's also worth pointing out it's also the opposite in Hong Kong of what we did yesterday, opposite of the gains that we had there. CGB market is coming on your screens. We have bond auctions today to tell you about. Loan prime rates, by the way, came out about an hour back. No change there. 2029 and 2036 bonds, of course, are being sold today. Right, we mentioned the Stock Connect. So the initial goings suggest that it's net selling southbound. So we are getting some flows coming out of Hong Kong listed names. That's going to be on the right side of your screens, that little red spot you see at the very rightmost side of our chart, which, by the way, is a live chart that updates too. There's the plug. We're looking at commodity markets in China coming online. The catch up there is the oil price. Apart from that, nothing much else as far as that catch-up trade is concerned. Oil, of course, while China was shut for the better part of 2 weeks, was the Iran story really gained a lot of traction. So 5% up on Shanghai crude. The rest of the region, you have the Nikkei, you have the topics, Kospi and Taiwan coming up on your screens. And as Yvonne is pointing out, largely, of course, avoiding the fate overnight that we saw there on Wall Street.
Yeah, look at Taiwan, too, coming back from their Lunar New Year holiday on a pretty strong footing as well. And it's interesting, right? You mentioned about the sequence of events that really kind of led to this sort of scare trade in the U.S. It really was from that Citrini Research report that, you know, it almost was like a dark, fictional
dystopia.
How when AI is too good.
Yeah.
What could it disrupt? And everything from software to food delivery to even the economy, and this sort of negative feedback loop, which we did speak with one of the authors, Alap Shah, about. And really, he himself said he was pretty surprised by the overall market reaction that we saw.
I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months.
That was the co-author, of course, of that report that scared the markets overnight. Joining us now is Lianting Tu, our managing editor for Asia Equities. Lianting, thanks for joining us. Apart from a very short list of names, SoftBank is one. It seems Asia is immune to the AI scare trade, not just today.
Yeah, I think the interview clip that you just showed is just reinforcing the idea among investors that Asia or Asia's tech giants are really well positioned in this AI boom in the data center build out. We talked about, the memory chip makers in Korea and TSMC, the biggest chip maker in the world. But if you look at Japan, they also have a lot of chip equipment makers. Again, these are the beneficiaries, right, in the AI boom. So it makes Asia a relative haven right now when U.S. is really concerned about all these companies, the intermediaries, according to Alap Shah, being disrupted. And if you look at Asia, you don't actually have all these big intermediary stocks listed on Asia exchanges. Again, so that is bolstering the case that Asia resilience or Asia outperformance, which is at a record against S&P 500 right now for year to date, is going to continue.
Yeah, and certainly I think China in some ways benefits from that, right? You take a look at how the likes of Zhipu, Minimax have really done so far this year, Lianting. This market reopened in China. We had a positive backdrop when it came to the tariff situation, maybe the whole AI plays as well. But there is sort of this theme that we're seeing among a lot of the analysts out there about they're taking part in EM ex-China here right now.
Yeah.
Yeah, I think for China, the narrative, there's a huge contrast between China and the U.S. right now in terms of what people are focused on. In the U.S., it's AI scare trade, a lot of anxiety there. In China, people are talking about holiday spending being really, really good. If you look at bookings for a family trip over the holiday period, it was up 76% year over year. And people are again talking about robotics, the ones that can play Kung Fu in the Spring Festival Gala, and there is a lot of advancement this year around versus their performance last year. So again, that's becoming a focal point for investors. And also China itself is racing to win this AI race. As you guys mentioned, the large language model makers, Minimax and Zhipu, is still leading the way. So overall, there's a lot of optimism when China is now coming back online. Of course, the tariff news is also helping. We've talked about how China is an outstanding winner in this Supreme Court ruling, just because the 10% fentanyl tariff will be dropped, and China is now facing the equal tariffs with the trading partners of the U.S.
Okay. Lianting, thank you. Our managing editor for Asia Equities, Lianting Tu here. We're just have some lines here crossing when it comes to China. So we are hearing when it comes to the Ministry of Commerce here. Okay, so they have banned the dual-use exports to 20 Japanese firms. Well, we are hearing in terms of some of the list of companies that they're talking about among this 20, Mitsubishi Heavy Industries, Kawasaki, that are under this export control list right now. So we're trying to kind of see what the details are, but it seems like they're adding some of these Japanese companies to list on national security concerns here right now. What else do you see, Dave?
Yeah, well, the market reaction seems to be, in fact, as this line's dropped, it's now gaining traction. We were down, but we're down much further as we speak. Well, we have 20 firms now. Well, so far, this is actually in Mandarin, so we need a bit of translation and as far as the actual statement is concerned. But, the headline tells you most of the things you need to know at this point in time. We'll dig into this a little bit further. But, yes, this is an announcement coming through out of China's Ministry of Commerce, talking about how 20 Japanese entities will be added to that export control list. And yeah, that's what it's a very, very short statement, of course. So we'll keep on top of this. Right. Coming up, we'll put everything from geopolitics, which goes into this fluid tariff scenarios situation that markets are trying to grapple with at the moment. Ray Farris joins us. He's with Eastspring Investments. He's chief economist. He's joining us out of Singapore in a moment. Keep an eye on that, plus others, more ahead. This is The China Show.
More of the tariff situation now. The U.S. said to be preparing a series of investigations that would enable President Trump to impose new tariffs. Now, a source says industries in focus include batteries, electric grid and telecom equipment, plastics, and industrial chemicals. Now, the investigations would be under the Section 232 of the Trade Expansion Act, which allows the president to impose levies based on national security concerns.
Right. The EU has paused work on ratifying its trade deal with the U.S. as it warns President Trump's new tariff policy will breach the agreement. Now, the European Commission says Trump's new 15% global tariff would be added to levies already in place, taking the total above the agreed ceiling. That's the operative phrase there. Now, without naming any country or bloc, Trump posted on social media that anyone who plays games with existing trade agreements would face even higher tariffs.
Let's bring in Ray Farris now, chief economist at Eastspring Investments, and he joins us out of Singapore. Ray, it's good to have you on the program here this morning. Just given that, we're still trying to figure out if it's 10%, is it 15% tariff rates in the U.S. now, but overall, I'm sure you had a chance to crunch the numbers here. Net, is this going to be a relief for much of the world?
Good morning. Thanks for having me. I think the summary is U.S. effective tariff rates have peaked. They peaked in October, November last year, and the SCOTUS decision has basically brought them down for most, but not all countries. Of course, Trump is going to try to use Section 232 and 301 to give him flexibility to recreate the tariff structure after these 122 tariffs, the 15% that he imposed from today, expire after about 150 days. But I think he's going to struggle with that for a couple of reasons. The first thing to say is I think the 122 tariffs probably will not be extended by Congress. I'm not certain of that, of course, but it's clear to me that there's a greater reluctance in Congress to embrace tariffs as a lot of the electorate move against tariffs because of affordability concerns and prices. The other thing is that against the background of that growing sort of reluctance to use tariffs, at least away from the president, I think they're going to become a political issue going into the midterm elections.
Okay, Ray, how does the U.S. economy look to you is my question. And I guess part of that question will be, what do you think the next move from the Fed will likely be? Is it going to be higher or lower, whether that's a year or beyond from this point in time?
Okay, so the economy is churning along. We expect growth of a little over 2% this year in GDP. The first quarter stands out in that it looks like there's a bit of a bounce in employment activity taking place. That's keeping the unemployment rate lower than the Fed's forecast and forcing the Fed to be on hold. Combine that with the PCE data that came out a couple days ago showing that core PCE, the Fed's preferred measure of inflation, is stuck at about 3%. And there are elements of the committee that are actually thinking about whether, in some scenarios, they may need to hike rates. That's an environment that's going to be just very difficult for the sort of 58 basis points that markets have priced by the end of the year to come to fruition. I think the Fed's a little overpriced.
A little overpriced. And you mentioned some of the Trump policies that are contributing to some of the Fed concerns, whether it's around tariffs. Oil prices obviously have been quite elevated recently as well.
Yes.
Are we expecting this year that the Fed is going to have to tilt towards, restoring jobs over, fighting inflation? I mean, are we likely to see that shift amongst the Fed this year?
Probably not. I think the greater likelihood is that the Fed just stays on hold through the first half of the year, maybe cuts rates once, maybe twice in the second half of the year. But the labor market's in a situation where labor demand growth has slowed but has not collapsed. If anything, there's a little bit of a bounce that's taking place early this year. Supply has slowed very dramatically because of immigration policy. There's basically no immigration into the U.S. this year. And domestic indigenous growth of the labor force is kind of maybe 0.5%. It's very slow. So the unemployment rate remains at historically low rates of 4.3 to 4.4%. I mean, if we were back in 2017, 2018, those would be rates that we would consider to be very low. So I think you've got a Fed that's just simply on hold for much of the year.
Ray, just to turn our attention to China, we have, of course, the two sessions coming up, where we have, of course, the growth targets being lined up in the next couple of weeks. The market specifically has run with the concept of new economy. So the AI plays have done very well. Cyclicals have not. I wonder whether we should be looking at growth, and can there be growth support coming from new economy sectors, or is that still just the market story for now?
The very clear message that we take away from government policy since October of last year, the first signals out of the plenum about the next 5-year plan, the December Economic Working Committee, and I think what's going to come out of the NPC in March, is that this is a government that's going to focus policy on selected sectors. It's not going to deliver a broad, general macro stimulus. Those selected sectors are very much going to be in new economy areas, not just AI and chips, but also elements of pharmaceuticals and medical devices and aerospace that the government sees as higher value added. It has to stimulate the economy. The economy is clearly slowed. We've yet to see, the first robin of spring emerge from any of the stimulus that's been announced so far. I think it'll really be closer to May, June before we get a clear pickup in growth, but it will be there. Investors are going to have to be very focused on following the Chinese government's stimulus rather than investing in the broad market, though.
Ray, I'm not sure if you read this whole AI report from Citrini over the weekend here, but they highlight what a pretty dark picture of what AI disruptions could have on the economy, right? Whether, this could displace jobs, and then it leads to, less investment, and then consumption sort of weakens, and then it could lead to the economy to contract as well. Obviously, we saw a very strong market reaction to the downside to some of this. But as an economist, how do you see this? Do you think that some of these concerns are a bit overdone?
My starting point is really to focus on history. And it's almost regardless of how far you want to go back through the Industrial Revolution, every time a new technology comes out, there are mass fears of mass unemployment. We can go back to the Luddites. And the reality is that over and over again, technology creates new jobs. It displaces the labor force. It moves people around from one sector to another sector, and that can create pockets of inequality. The data that have been published so far show that that's exactly what's happening with AI. So there is some inequality that's beginning to emerge. Higher skilled workers that are able to adopt AI are doing better than lower skilled workers that are not. Countries that have better infrastructure to be able to capitalize on AI are doing better than countries that don't. In that vein, Asia really stands out because almost all of our countries have clear, dedicated government strategies to developing AI infrastructure. You see that in Singapore, you see it in Malaysia, you see it in Japan and China. And that's one of the reasons why we think that Asia will continue to outperform.
Ray, Thank you so much, sir, for spending part of your morning with us. Ray Farris, their chief economist at Eastspring Investments in Singapore, joining us out of Singapore today. In other world news that we're tracking at this point, this powerful winter storm has knocked out power to 600,000 homes and businesses across the U.S. Northeast, grounding more than 10,000 flights and disrupting intercity rail services. Now, Central Park in New York City recorded about 20 inches of snow, but roads and bridges have been reopened to most traffic, and schools will resume classes on Tuesday. Now, forecasters say more snow may fall later this week. Now, a U.S. delegation is said to be planning to discuss nuclear options with Chinese representatives in Geneva. A State Department official tells Bloomberg that U.S. officials already met with Russian counterparts on Monday and will meet the Chinese group on Tuesday. The Trump administration is trying to start a new round of arms control talks with both Moscow and Beijing. More coming up. This is Bloomberg. Welcome back. You're watching the China Show. Panama has ordered the temporary occupation here of two ports operated by a unit of CK Hutchinson. That's after the country's Constitutional Court ruled against the firm's concession. CK Hutch, the Panama subsidiary, has reportedly called the port takeover illegal.
Our global business editor, Karen Lee, joins us now with more on this. And so tell us a bit more about this latest update. What does this mean for the company going forward?
Yeah, I mean, this isn't news that would have made CK Hutchinson very happy today. Panama ordering the temporary occupation, just looking at what we have coming across the terminal here, of two of its ports in a key strategic waterway. They're going to be taken over in the interim by Maersk and MSC, which are, of course, competitors. And the CKH unit, according to reports, immediately calling that move illegal. But the two things we're watching really closely are, one, how much this is going to spook investors who've had a lot of anxiety about recent moves over what's going to happen to these ports. And the other, of course, is how much of a cloud this is or isn't going to cast over Li Ka-shing's global ports deal for 43 of his global facilities, including those two ports in Panama. Now, so far, the stock was muted today. It was down less than 1% at opening. And after a top court in Panama struck down a concession to operate the ports in January, the stock fell. So that was good news for CK today, a bit less movement than I think we were expecting, and we'll see where this goes.
And Karen, how important is the ports deal, just in terms of the political backdrop right now?
I mean, it couldn't be more important, and it couldn't come at a moment when it's going to be more in the spotlight. I mean, just looking at this deal, it's really become a rivalry or a proxy for the China-U.S. rivalry and battle for influence in Latin America. And these two ports have emerged as a real flashpoint for that as they battle for influence in the Panama Canal in particular. Now, the U.S. cheered that Panama court's decision last month. China wasn't very happy, but take into consideration all of this is happening now against this backdrop, especially today, of Trump's latest moves on trade, of these escalating tensions over trade, over geopolitics. So this is something we're going to be watching a lot more closely than we might have watched it in years past, and a lot more closely than you might watch a similar kind of deal. It's going to be very interesting.
Okay, Karen, thank you so much. Karen Lee, our global business editor there. Right, let's have a look at markets and where we are. So we're reopening, of course, first trading session, year of the horse. You have the energy complex mirroring what we're seeing in the commodity complex as far as the catch-up is concerned. Apart from that, other sectors that are moving, IT and staples going the opposite way. We're down about 0.5%, so bucking the overall trend as far as the staples are concerned.
Yeah, I think, some of the numbers that we got in terms of Lunar New Year, in terms of the consumption space, I think did underwhelm in some ways. We certainly saw that yesterday in the H-share market. So we'll continue to see and get more, of course, how the Lunar New Year shaped up when it comes to the consumption side of things. More data could be coming up in the next few days or so. But yeah, if you're talking about flying, I mean, there's always that long debate. Do I fly Singair? Do I fly Cathay? Well, JPMorgan says, why not both, right? Because both upgraded to overweight from neutral here. And they're really talking about how they have tight industry supply, strong traffic growth in the region, and the ability to really flexibly redeploy capacity to the most attractive markets. So they're saying that it's a structural improvement in terms of earnings visibility for both. Right now. Cathay Pacific, though, that's an upgrade, I think, of 40% or so in terms of the price target.
To be be completely honest, and this is a personal view, when you put airlines and upgrade in one sentence, the stock is not what first comes to mind, and nor is that my preference, right? There is a specific type of upgrade that I'm waiting for the airline to do every time I come up with my Jingji Tan ticket.
Yeah.
And I'm hoping for that red beep.
How often do you get that red beep?
As often as certain economies beat expectations as far as growth is concerned. So it's mostly median, if not disappointing to the downside.
Yeah.
But one can hope, right?
Because I never get my hopes up on that,
right?
That upgrade. It's just, just don't get your hopes up.
No,
okay, we're taking a look when it comes to some of these Japanese military stocks as well. So this was a bit of a surprise, right?
Yes,
what we
this is a
heard
big story.
from MOFCOM from China just the last couple of minutes of adding 20 Japanese firms to this export ban list. The 20 of them, among them, are more military sort of industries and the like. So the likes of Mitsubishi Heavy there. We saw it reversing some of the initial gains here. We're down close to 3%. This is Bloomberg. 11:29 a.m. in Tokyo. Japanese markets are going on a break in just a moment. And it looks to be a pretty decent day in Tokyo here today. Nikkei 225 is up 0.75%. Interesting to note, though, we talked about some of those military firms and the like in Japan that have been added into this export ban in China. Those have seen some really massive reversals there in the last couple of minutes or so. So that is one to watch here today.
Yeah, we'll keep an eye on that. We are on the break, but it certainly doesn't look like anything you see on your screens on a benchmark level. Right. As far as the AI trade and AI scare trade specifically in the U.S. is concerned, whether or not you're looking at some warnings coming through out of Anthropic, we'll get to that in a moment, or this thought piece that were released over the weekend. We talked to the co-author, by the way, earlier on. If you're curious, that's on TV Go. You can scroll back to that. Or some warnings coming out of Black Swan's, the Black Swan author. It's showing up in the form of SoftBank. That's what I want to get to here. Down about 5% on there going into the break there. Apart from that, Asia's actually doing quite decently and well. So we're up about 51%. S&P futures, I should also note, are bouncing off following the cash market session overnight. So apart from a handful of weak spots, consumer discretionary, financials actually are standing out to the downside, 1.3%, and consumer services 2%, and I imagine that's 10 cents when I get into that. That's my bet. I haven't even looked at it, but I'll correct myself if I'm wrong. Apart from that, we're doing quite well as far as the region is concerned.
Yeah, and we're checking shares of Minimax, the like here, and really we have seen this massive rally around sort of the pure plays in China. We saw a bit of a drop there yesterday. They seem to be recovering here today. In fact, Minimax, take a look at that, is up some 7%. Drupu also is up double digits here right now. There has been, of course, that story when it came to Anthropic, right, and these allegations of copycat behavior. Let's bring in our Asia Tech correspondent, Annabelle Jewellers, to really kind of flesh out the details for us on what Anthropic is saying now.
Yeah, so they're talking about distillation techniques, which isn't the first time we've actually heard about this, because this accusation of Chinese AI companies using distillation techniques was also levied by OpenAI against DeepSeek just a few weeks back. But the latest allegation here is that Anthropic is saying not just DeepSeek, but also Minimax and Moonshot, which these are three startup ones, of course, of varying interest
levels of success?
No, I was going to say levels of awareness, essentially.
Okay.
Because Minimax listed in Hong Kong earlier this year, Moonshot is still held privately.
That's right.
DeepSeek, of course, is really well known globally. But these three companies use distillation techniques to essentially copy Anthropic's models. And so distillation techniques is about having a small, compact, so-called student model, and then you want it to be able to mimic the behaviors and the knowledge and the patterns of a more advanced teacher model. And so essentially they're saying that they use a web of different accounts to do this and generated more than 16 million exchanges with the Claude models in order for that to happen. So it is a big concern. As I said, OpenAI was saying the same thing about DeepSeek, and they've also been talking about this in Washington because the AI czar David Sachs has also said he's concerned about the risk of this happening.
I want to ask you about IBM in a moment, but have we been able to distill a response from these Chinese names?
No response from the Chinese AI companies, which you might expect. I mean, I think it'll be interesting to see. Earnings for Minimax are confirmed, or rather, tentatively scheduled. So we'll see if they come up in the next, say, even this week, next week, and then as well, ZAI has their earnings on the docket, but they haven't actually faced these levels of accusations either. It just will be interesting to see if it does, of course, get asked as an analyst question, for instance, or during those earnings calls. It's a big point of focus, I think, the technologies and the methodologies that they're using.
What does IBM have to do with all of this? COBOL, and we're back to 1959, I believe.
1959 is when COBOL, the programming language, was introduced, which is pretty crazy. And I think some people might think that it's a legacy system. It's not that integral. Actually, it is. If you go onto IBM's website, they have a post where they sort of lay out how important it is. And I was just taking a look. So it's the foundation for more than 40% of all online banking systems. 40%. It supports 80% of in-person credit card transactions.
What?
And it handles 95% of all ATM transactions. So it's a system that's powering around $3 billion of commerce each day. It's used across airlines, governments, finance. Many different sectors are relying on this computer programming language. The issue, though, as you say, in 1959, is that it's an older system. There's not a lot of people that can maintain it. It takes a long time to do so. Legacy, cumbersome, and so Anthropic is saying that their Claude Code tool can essentially replace the work of those computer programming engineers and do it in really short order. And so that is the risk for IBM directly, especially because they're making still a lot of revenue off their mainframe business that does rely on COBOL.
There it is. Okay. Belle, thank you so much. Annabelle Jewelers, as you can see, we're still up 71%, but we're down about 24, of course, from the peak there on the share price of IBM. Okay, this goes into this report, which caused a lot of disruptions, obviously, overnight on the scare trade. So the co-author of that report, in fact, which came out, I believe, on Sunday, on the weekend, certainly helped fuel this latest scare trade and this move down. Says investors are now moving from an everyone wins scenario to picking real winners and losers.
Yeah, Lotus CIO Alap Shah told us that AI agents could soon spark a rapid economic upheaval, threatening to wipe out white-collar jobs far quicker than anyone expects.
The timeline, we were seeking to just find a time period that is far enough away that ultimately we can start driving a conversation on what needs to be done to avoid such a timeline. But near enough that would kind of shake people a little bit, and ultimately we do think it's going to take a while for this to diffuse through the entire economy. But it's more a question of what happens at the leading edge. I think especially in the U.S., the job market is just very weak for white collar jobs already, and so the thinking and the ultimate fear is that it's not going to take that much to sort of push things over when we haven't really generated any white collar jobs in the U.S. over the last 3 years. When they take out things like healthcare and education that are primarily driven by government spending. And so that's kind of the underlying thesis here, is that there's going to be significant replacement of jobs with AI, specifically AI agents. Those things only really came into fruition in the last few months. And so as it comes through and shows up in the productivity of different corporations, that's when things are going to get a little more interesting and where we got to pay real attention.
Alap, David here, were you surprised by the market reaction?
Yeah, I was. I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months, and it's going to start changing. It's not just going to accrue to the benefit of every corporation and every foundation lab and every semiconductor company, but instead it's starting to disperse and figure out, hey, who are the winners going to be and who are the losers going to be. And so, software is the best example. The markets have been selling software for almost a year now on the AI threat. but they really accelerated in the last few weeks. And this is, the problem with this, if you're long software, is there's nothing to actually disprove the thesis, because the thesis is a few years out. It's not today, but you have not much to stand on, because ultimately that thesis is going to get stronger as AI itself gets stronger. And so we just are entering a really kind of highly volatile time in the markets, because the timelines are short, but the things are in fact happening now.
Yeah, I was about to say 2028 is closer than the most recent presidential elections, right? Let alone the pandemic, which in my mind seems still very, very fresh. Alap, I just would have been doing my duty if I didn't ask you this. Were you or anyone at the research firm short these names going into this? Was this a short seller report guised beautifully in the form of a beautiful fiction?
We are constantly sort of, turning our book, and we certainly had shorts in some of these businesses. We generally have a set of shorts out against businesses that we think are going to be disrupted by AI. And on the other side of that, we own a lot of semiconductors that we think are going to benefit. But ultimately, we just wanted to get this story out to the market, because while the risk to individual stocks is certainly meaningful, the main story for us is that the risk to the overall economy and ultimately the consumer economy in a world where, we don't figure out what to do if the jobs start going faster than we think.
I'm just wondering, what we're seeing the market reaction, we're not quite seeing that here in Asia, particularly when it comes to China itself. In fact, some of these pure plays in China are actually outperforming, and it has been a dominant theme here in China. Is there a sense, China's making cheaper AI models. Is there a sense that they can actually in some ways overthrow some of these offerings, the likes of Anthropic and what they're doing now, at least outside the US?
I think there's two really interesting observations with what's going on in China right now. I think clearly these foundation lab companies that have recently listed are really zooming. It's not surprising to me. They're really the only way in the whole world that you can get exposure to foundational lab companies, because none of them are public in the US, except unless you want to buy Google, when you're buying a bunch of other things too. And so clearly there isn't that much supply. Everyone in Asia, but I think, folks all over the world are rushing to buy these stocks in Hong Kong. And so it's not surprising to me that they are outperforming and other parts of the AI complex are outperforming. The other thing that I find really interesting about China, and maybe that reflects in kind of what you're seeing in a very muted response today, is there might be a good analog here for what happens over the next 2 years in the US, to some extent what has happened over the last few years in China, where as technology, not some AI, but other things as well, especially automation, have really rolled through the economy in a big way. Jobs aren't being produced at the same level. The average corporate can do a lot more with less humans, and they're able to ultimately not hire, and it leads to sort of a pretty weak consumer economy that kind of can drag the entire economy down. So I think there is probably some interesting analog there as well. And so I think, there's just a lot less expectation sort of embedded in sort of China's growth from a consumer perspective right now. And so thus, this, if it gets a little bit worse, shouldn't matter in the same way that, there's quite a bit embedded in kind of the US.
That was the Lotus CIO, Alap Shah, speaking to us about the report that he co-authored, actually, for Citrini Research that's fueled this latest AI scare in these markets.
I think it's worth a read, this post, right?
It's quite long.
It might be the most extreme scenario, but I think it does leave investors with a bit of a, I guess, message that, there are going to be some tail risks around this whole AI discussion, right? And it reads like a novel in some ways. And really they even use Bloomberg articles from 2027. They say the future articles we might write when it comes to the earnings of some of these sectors, when it comes to the DoorDashes, the Ubers and the like. But I love this one line. We have overestimated the value of human relationships. Turns out that a lot of people called relationships was simply friction with a friendly face. That, people thought, at least we still need people to manage the AI and the like. And he's saying, no, there's going to be agents out there eventually that's going to look at these tedious jobs and not look too tedious.
Yeah.
Pretty dark.
It's pretty dark. It's almost like a dystopian, not too far in the future, right? 2028. And he said that was a date that deliberately they picked, not so much to scare people like it's coming, but also not too far away that it's far enough that we don't be worried about it. The policy implications, I think, is what you're getting here. The governments need to look at how this economic imbalance is going to address the coming economic imbalance.
So basically, he says, in terms of how to break this negative feedback loop to markets, to the economy, is that you have to start taxing AI here to help really offset the impact when it comes to job losses. So he offers maybe there is some signs of avoiding this sort of scenario that they've laid out quite interestingly. But yes, definitely worth a read when it comes to, what do they call it? The global intelligence crisis.
Yeah.
Of 2028.
Right,
just to counter that, right? I mean, there were a lot of questions of whether this market reaction was a bit exaggerated, right? We heard from JPMorgan CEO JP Dimon as well, and he says, when it comes to the fears about AI sweeping through markets here right now, it could be a bit overblown, he says, and that the bank would use the technology to its advantage. He spoke during its JPMorgan Investor Day.
In my view, we will be a winner, but at the end of the day, if you look at 100 areas, we'll be a winner in 75 and maybe a loser in 25. We've always had the strategy to use technology to do a better job for our customers. And we're quite good at it.
Meanwhile, Dimon says he is starting to see parallels to the era, I can't imagine, this is almost 20 years ago. So before the 2008 GFC, that's a global financial crisis, when a rush to make loans ended, as we know now, disastrously. Now, Dimon was responding to a question about fierce competition in the financial industry.
Unfortunately, we did see this in 05, in 06, in 07, almost the same thing. The rising tide was lifting all boats. Everyone was making a lot of money. I don't know how long it's going to be great for everybody. I see a couple of people doing some dumb things. They're just doing dumb things to create NII or say they're winning in the markets business, something like that.
Right. In case you missed it, this quite steep losses going into the Japanese lunch break here across some of these big Japanese names. Industrial giants, Mitsubishi, Kawasaki, heavy there, industry are falling. You have China's Commerce Ministry about 30 or so minutes back, naming them among the 20 firms in Japan on its control list for dual-use items. Min Lo, our China correspondent, has the details for us from this statement from the Ministry of Commerce.
Yeah, this is quite a swift response from China's Commerce Ministry, coming soon, a couple of days after Takaichi made her first post-election speech on Friday, where she talked about China's coercion and talked about wanting to revise or overhaul Japan's defense strategy, strengthening its supply chain, strengthening defense companies, and even, revisiting the rules that restrict the export of military items. And I think China sees this as quite a departure from its pacifist constitution, and of course the root cause of it was started many months ago when Takaichi made that comment about Taiwan that was really left to fester as she didn't retract her comments, which was something that China has been pushing for. So now China is punishing Japan and ramping up tensions even further with this latest list of export control, placing about 20 companies. You can see some of those companies on the screen there, and most of these companies are military related. They are ship makers, jet builders, engine makers, and yes, the latest retaliation between the two sides.
Yeah, we'll see how Japan responds, but certainly this one came out of nowhere in some ways for us as well. All right, Min, thank you. Our China correspondent Min Lo there with the latest on this export ban. We're talking a little bit more about Iran now here. President Trump has pushed back on reports that the Pentagon is concerned that an extended military campaign against Iran could prove difficult. Now, he rebutted earlier reporting, including by the Wall Street Journal, that suggested that Joint Chiefs of Staff Chairman Dan Kane have been underscoring the risks of striking Iran.
Lena Del Valle is with us, our national security reporter, to talk us through this. Markets have been trying to figure this one out, what potential military action is likely on the table here. What has President Trump been saying specifically about that?
Hi, yes, thank you for having me. As you said, there's reports that the Pentagon has expressed concerns over the effects that could come from strikes on Iran, but the president has denied the claims and continues to voice his optimism over what strikes could achieve, and doubling down on what Chairman Chief of Staff Dan Kane said, and that he said that the U.S. could easily win against Iran. But regardless of what Chairman Chiefs of Staff said, even though Trump Trump is convinced that he can win, and he's really ready for this attack. On Monday, the state evacuated non-essential personnel from their embassy in Beirut, which could signal that there's something going on in the region. State didn't specifically mention Iran as the reason for the evacuation, but they said that they analyzed what was going on in the area and that it seemed prudent to tell their staff to leave. So that sends some signals. And around Iran, we're seeing that what's probably the largest U.S. military buildup in the Middle East since the 2003 invasion of Iraq, including 2 aircraft carriers, fighter jets, and refueling tankers. So we don't know the exact odds. Trump hasn't said, we're striking tomorrow. He actually gave Iran 10 to 15 days to come up with a deal. But these timelines are sometimes fuzzy, and he's ready to go at any moment, really.
Okay, so how likely are these strikes then, Magdalena? And what is the latest when it comes to where negotiations between U.S. and Iran?
Well, negotiations are still very much ongoing, with the latest round scheduled for this Thursday in Geneva. Jared Kushner and Steve Witkoff are planning to attend, and they're Trump's most trusted envoys on these issues, so they might reach a deal. But the objective of these talks is also a bit fuzzy, and different officials have different goals, and depending on what goals they ultimately pick is whether or not we'll have strikes. So if they decide that they just want a nuclear deal, which is something Trump has said and other U.S. officials have said, then the Iranians might be willing to negotiate something like that, and we might see a deal on the table, and then strikes become less likely. But if they decide to push a little bit more, which is something Marco Rubio is very adamant on, and which the president has on occasion been insistent on, but on occasion he's backed off, they would want a deal that deals with Iran's missile program, suppression of protests, and limiting support for proxy militant groups across the Middle East, such as the Houthis and Hezbollah. These issues for the Iranian regime are existential. They define who they are, they protect their sovereignty. So if the U.S. tries to touch them, they might draw some really hard red lines. And if the U.S. isn't willing to let them go and really wants all these things to go as they wish, then strikes might end up being the only option.
Magdalena de Valle, thank you so much there. Our national security reporter joining us out of New York, where it's getting late and still very, very cold, of course, given the weather outside. A reminder of our new online feature, the Bloomberg Video Hub. Subscribers can explore live streaming. You have interviews, news, and all the TV shows across Bloomberg Television. Check it out, bloomberg.com/videos. Right, welcome back. We're looking at some of these payment-related stocks on your screens, and as you can see, we're not doing too well. And again, this is another derivative of this AI scare trade that just goes down completely the value chain here. But yes, so far this is across the region, so everything from Bay Current, of course, which is listed in Tokyo. You have a couple of names in Korea there on your screens. Kingdee is a Hong Kong listing, so it's agnostic of where these stocks are listed, I think is the point I'm making here.
Yeah, and I think a lot who we had on the show, mentioned in terms of, where is best to kind of park your money then, if in fact this sort of disruption is going to continue on for the next few years or so. And he said it's the semiconductors, it's the data centers that they say could have a lot of upside from here. So certainly those are still the sectors that are maybe safer in this whole sort of AI disruption wave. In terms of China tech, we're watching very closely, of course, some of these names as well. When it comes to Tencent, Alibaba, some of the internet giants have really they've gained a little bit this year, but really it's been overshadowed by really what has been these national champions of AI, right? The Zhipus, the Minimaxes of the likes here. But really, overall, Aegis Tech is lower by about 2.5%.
Commodities also coming back online. I think you really have a standout as it pertains to energy. And as you can see on your screens, energy and some of the big mining stocks there are doing very, very well. Before we go, a quick glance at the movies. China film stocks slumping. You have soft holiday box office sales. And yeah, that's it from us here on The China Show. We have plenty more ahead here on Bloomberg Television. Insight with Azuna Amen is coming up next.